We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides.
And we're back with Liberty Nation's economics editor, Mr. Andrew Moran. Earlier in the show, we were talking Silicon Valley Bank, the fallout, and the solutions. But now, Andrew, I want to turn to inflation. We had the CPI figures out this last week. What were the cliff notes on that, please?
So the annual inflation rate was 6%. This was down from 6.4%. Core inflation was roughly flat at 5.4% year over year. The key components of the inflation report, as you noted in my article on LibertyNation.com, the food supermarket price was still above 10%. Eggs actually noticed a decrease, actually fell to 55% year over year, as opposed to, I think it was above 70% in the last report.
But Americans are bracing for the two-egg omelet once again.
But the main issue, and this is what the Federal Reserve keeps monitoring, is that services inflation is still elevated. It didn't change. It was still flat at 7.6%. But 7.6%, that's a huge inflation rate for the service sector. And then you have the next issue whereby if the U.S. averts a recession and the consumer is still well capitalized, which at this point, who knows that's even true anymore, then you're going to have a cycle whereby inflation is going to be elevated back in the goods buying sector, as you saw at the beginning of the inflation crisis. So overall, sort of services inflation is the point that everyone's monitoring, and the Federal Reserve. I would stress that the next key meeting is important, probably one of the most important meetings of the year because of what's going on with SVB and what's going on with inflation.
Okay, so let's talk about the services inflation here. That counts for what specifically?
That counts for medical services, financial services, pet services, anything leisure, hospitality. So it's a broad sector.
And this is a particularly large chunk of regular Americans' paycheck.
Yeah, especially in this day and age where the economy reopening and people are frequenting the establishments that offer these services. Yes, that counts for a large percentage of both their paycheck and the CPI as well.
So I guess my question has to be, Andrew, we see it at 6%, and 6% was the expected figure, roughly the expected figure. So does this mean that 6% inflation is now the new normal?
Well, not necessarily, because, well, it's funny you mention that because I wrote an article on Liberation.com, another one.
Andrew is a prolific writer on the site. Do please check it out.
I discussed how, because a lot of people are discussing, should the Federal Reserve just raise its target rate beyond 2% in order to exact confidence to financial markets? So, because that 2%, it's a pretty arbitrary figure. I mean, why 2%? So is 6% the new figure? Probably not. The Federal Reserve keeps stressing how it's going to do everything it can to bring down that inflation target back to its goal of 2%. So I don't think 6% is the new norm. However, I think that you're going to have a case similar to what happened in the late 80s and early 90s, where you did see an easing of inflation, but then it went back up as the Federal Reserve kept easing monetary policy, and then it raised rates, cut rates again. So it was an ebb and flow of inflation that really hurt the U.S. economy at the time, and I think that's going to impact the stagflation environment of the U.S. today in the future.
So you've talked about how the way with which to sort of cut the rough edges off the inflation would be for the Fed to raise interest rates.
Well, yeah, that's the whole point. The whole point of the Federal Reserve raising interest rates is to kill demand. But when you're killing demand, of course, you have that recession. But I think the main factor in this inflation fight is the M2 money supply, as alluded to earlier. That's actually contracted for only the second time on record, and it's been on a steady decline since it reached its peak in April 2021. And so now the money supply is, I think, at about $20 trillion as opposed to $22 trillion. But still, I mean, that's money you going away from the system. So when you have that inflation fight going on, and then, of course, when you have this bank crisis going on too, it inevitably weighs on economic growth. So the latest forecast is that from Mohammed El-Erian. He's a well-known economist. He's saying that probably for the future, as opposed to recession, you're going to have a stagflation environment of elevated inflation, slow economic growth, and perhaps higher unemployment. But it seems like this labor market is the one that never dies. It's just going to continue booming. So because in the last report, you didn't see any weakness at all. You still saw another 300,000 new jobs. So then that was the 10th straight report that beat market estimates. So I think I call this economy the nothing is what it seems economy, because you have no clue what's going on in this economic landscape. Some measures point to weakening, other point to strong growth, others point to high inflation, other point to there's some disinflation going on. So this is such a difficult economy to navigate for anybody, because most people have never, even Jerome Powell alluded to this, he's never seen an economy like this before.
I think the important thing to get a handle on is how it affects the lifeblood of America, which are your small businesses. Now, how does the inflationary costs and the interest rate battle, how does that impact the millions of small businesses that drive the country forward?
Well, okay, so there are a variety of answers to that question. I don't know.
Let's start with the simple one and work our way upwards.
So if you look at some of the PMIs, the Purchasing Manager Index, they give you direction of where certain trends are heading. So one thing you're seeing in all these reports that there's a reacceleration in input costs and output costs. So that adds to inflation pressures. So with small businesses, not only do they have accelerated input costs, they also have still higher wages, which weighs on their expansion of their companies or operation of their companies. So that needs to weigh more into their sort of profit margins and balance sheets. When it comes to interest rates, when you have higher interest rates, that also adds to creates two environments. So first, you have higher debt servicing payments, so it costs more to maintain these debts, which a lot of small businesses rely on. The second one is accessing capital. So if you look at, there was a recent Federal Reserve Bank of New York survey of consumer expectations, and one of the results show that more people think it's going to be more difficult to access credit. So that's another issue for small businesses.
I could just interrupt very quickly. With small businesses, I'm sure most of our listeners are aware of this, but small businesses use credit options not because that they aren't fiscally viable, but because they have to deal with suppliers on different timescales to them, different billing supply time scale. So it might be they might have a credit note out for 3 months or something to one of their clients, and so that wouldn't appear on their balance book. So for them, they rely on credit to fill that gap until clients pay up, and I think it really cuts any profit margin they really have out of it when credit is more costly, doesn't it?
Yes, of course, that is true. And then to add to your point too, is if these other companies are, especially the larger ones, if they're struggling in this environment, then of course it's going to also weigh on these small businesses and try to hurt their payment system or hurt their balance or the bottom line. And also one more thing too, if you look at some of the surveys of small business like the NFIB, a lot of them show that there's weakening going on in the broader economy. Their optimism has been pretty much stagnating for a few months now. So that's another thing to look at, because one thing that the Federal Reserve looks at is confidence in the broader economy. So if confidence is weakening, then that impacts how they respond to inflation, how they respond to economic growth.
And every time the market bell rings, an angel gets its wings or retires to Florida. Andrew Moran, thanks ever so much for joining us.
Thanks for having me.
We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides. Entertaining, informative, and just plain fun. Watch Liberty Nation's The Conservative 5. Produced by conservatives for conservatives. C5's The Left Free Zone. Hosted by Liberty Nation's Lisa K. Donner. Joined by a raucous, irreverent panel of authors. Deconstructing leftist narratives. Debating the hot topics. And remembering to laugh. Join the official conservative safe space.
You only did that to piss Jeff off.
Liberty Nation's The Conservative 5.